Ryan here with James D. Piazza, Bond Street Mortgage, with our weekly mortgage update. How you doing, James?
Good, Ryan. How are you?
Great. We're going to jump right into it today. We were just talking about buying and refinancing condos, specifically non-warrantable condos. Do you want to explain what that is and what the problem is with them?
Sure. Non-warrantable is a term that defines really from a financing perspective. Okay, so a non-warrantable condo is a condo that cannot obtain conventional financing. And when we talk about conventional, we talk about the best interest rates, the best possible terms. It's not that the condo cannot get financing, it's just that you need a certain type of financing. And typically it's a portfolio type of financing, which we can most definitely do, but you have to be aware that typically that do carry, not much higher, but at least 0.25% higher in interest rate when financing a portfolio loan as compared to a conventional agency loan like Fannie Mae or Freddie Mac.
Okay, so people might hear that they can't refinance, or an agent might tell somebody, no, you're not going to be able to get a loan on that condo building, but because a lot of lenders aren't, but some can.
Correct.
So that's just a big takeaway here. Don't rule out a condo building because you heard it's hard to get financing, right?
Yeah. So there's a number of different reasons why the condo would be considered non-warrantable. Some of them are actually minor things, and some of them can be more major. And obviously, you want to be informed when looking at condos that you understand that things can be as little as they underfunded the reserves in the budget, or that one entity owns more than 10%. Or there may not be adequate insurance coverage, which is a little more major, and that's something you'd obviously want to take a look at. And probably the biggest thing out there today is that the condo has litigation. Now, slip and fall litigation is typically not an issue. If a unit owner is suing the HOA because they forgot to mop the floor in the lobby, they slipped and fell and broke their arm, that typically that type of litigation between a unit owner and the HOA, or a unit owner and another unit owner, is typically okay. We can most certainly get around that. But the bigger litigation is when the litigation is between the HOA and the developer, and there's no set dollar amount. And if the construction defects, things of that nature that are typically larger ticket items, that's where it's impossible to get conventional financing, and you have to go into the portfolio market.
Gotcha. So the solution is to go into the portfolio market, kind of.
Yeah. So, and some people say, oh, then maybe I don't want to buy this place, and it's obviously something to think about, especially if you're remarketing the property. Typically, portfolio lenders will not do any loan less than 10% down. Many of them want even 20% down. So you have to think about the marketability. But I will also say that quite often, those litigations are ongoing, and typically it's about insurance money, right? So they're going after the insurance money, and they typically are settled over a period of time. So you could look at it from a different perspective, as if I'm going into this project and you're looking at the budget, and financially the project is sound, and this litigation is pending, and let's say the defects were cured, and now they're going after the developer, and they're really going after insurance money to get their reimbursements, and that litigation is going to go away. You actually may be buying a property that has a little bit of built up or pent up equity in it, meaning that when that litigation goes away, the pool of buyers that can then buy in that project goes way up, which then makes your property more desirable, which we can then say would also raise the value. So it would be an investment play as well. Now, I know certain projects that have litigation like this, and there's structural defects, and they don't have the money to fix the problem, so the problems are getting worse. So again, it really is a case-by-case basis when looking at condos, and if they're non-warrantable, if you should get involved in that transaction. And you typically keep a database of many condo projects across the country that we can cross-reference. And if we don't have it in our database, it's very easy to get a condo, what's called a condo questionnaire, filled out by the homeowners association that will answer a lot of the questions for us up front. And they typically run $200 to $300, and it's the best investment a buyer can make in getting that information from the HOA.
Great. Yeah, that's fascinating, the pent-up equity stuff. So do you know of buyers out there targeting non-warrantable condos and buying them as investments, or sounds risky?
Yeah, it definitely is risky. Again, you have to really look at, in my opinion, again, many of the projects that I see, it's transitional litigation where there might be some structural defect, or the attorney is advising the HOA in case there is a defect. Maybe, especially in the larger projects that are often, more recently built, there's this transitional litigation that they will put against the developer in case of any structural issues that have been found, because transitional in the sense that the sponsor or developer owns the project until the HOA takes control of that project. So in that transition from developer sponsor to HOA, litigation is typically used to CYA for somebody. So that is a problem because it's typically, there is no dollar amount. It's just kind of open-ended. But to me, like any other investment, it's about the numbers and it's about the finances. So I say the budget and the insurance policies are what's more important in a condo project. And if there is structural defects, that they would be taken care of. But if the litigation is still ongoing, what you would really want to look at is the budget. Is the project financially sound? The budget will show you the revenue from all the HOA fees, all the expenses, any funds left over that would be funding like capital reserves for the project. Obviously, if there's negative funding or assessments for special assessments for those defects, and there's no reserve funding or the insurance is inadequate, then I would say you want to stay away from those projects. But if financially they're sound, then there's litigation, but you have to put a little more skin in the game. I don't see any issue with that. Chances are they could, not settle the litigation, but in many instances it is settled. The insurance companies do step in and take care of the issue on the benefit of the HOA. And I definitely have seen projects appreciate once that litigation is removed.
Cool. So where would somebody get a list of these projects? You said you maintain one. Do agents have them?
We maintain one internally. I always advise clients, and we do as a company advise clients that, so in the mortgage, we're obviously, we're looking at you, but when you're buying a condo, we're looking at you and the condo. So typically, your agent may send you 5 or 6 condos. You like 3 of them that you're going to go see. Contact us beforehand. Let us know those project names. We'll definitely do the homework for you in as far as what we have available. Let you know if we find out anything. And sometimes projects don't come up, which is either good or bad, right? So in those instances, we would say, be glad to share, just like we're talking about here. You want to ask those questions of the realtor. Maybe there's a condo questionnaire that would have been completed recently that we can take a look at. And therefore, when you're starting the loan process, we have a really good idea if we can, how we can finance that transaction, if we can use conventional terms or have to go to the portfolio route.
So it sounds like the problem here is you can get pretty involved in a transaction and then it gets to underwriting. And
exactly, that's the biggest mistake that's made out there today, and the larger lenders and banks make this mistake, right? They say, okay, you're approved, you're 800 credit score, you're putting 20% down, because it can happen even at 20% down, 30% down. It really doesn't matter the percentage down. It's that questionnaire then comes back later in the process, and now there's litigation, and then we have to change the program, we have to change the rate. If we have to go portfolio, as a consumer, you're not going to be happy about that, but that's the reality of it. So we really try to do that homework up front and say, look, we know there's a timeline, we have commitment dates and closing dates. The most important thing is that if we're going to go forward with this transaction, that we can do it. Give us a couple extra days up front. We'll research the condo, we'll get the questionnaire, we'll have our team internally take a look at those items, and with confidence say, okay, this is the way we can finance this, and this is the way you can proceed. That is usually done by most lenders, and especially the bigger banks. It's done way down the line, sometimes close to closing, and then you get a phone call and says, "Oh, sorry, this loan is, this condo is now mortgageable. We can't finance this loan." And you say, "Wait a minute, you've been working with me for 45 days. I'm supposed to close next week, and now you're telling me this?" So it is important, the condo projects that you're looking at, to share that information. Now, at 10% down, you can, on a conventional loan, you can do what's called a limited review condo. Okay, and sometimes at 5% down, but it's very much more common at 10% or greater down. But there still is a vetting process with a limited review, and one of the questions that is asked is there litigation. So if that question is answered yes, it now becomes a full review. If you're a first-time home buyer and you're using a first-time home buyer program, like a Home Ready or a Home Possible product that only requires 3% down, that would be a full review. And there we would be looking at the budget, at the insurance, at answering all those questions. The questionnaire has, many more questions that they have to answer for full approval. And if you're using FHA financing, the whole project, or VA for that matter, the whole project has to be approved by the FHA or VA for it to be eligible for financing. So again, we may pre-qualify you with 3.5% down on an FHA loan. You may want to go buy a condo. Well, let's look at what FHA has approved in that area condo-wise, and those are the condos you would want to focus on. So there's options. It's just what's the right option for you.
Cool. So definitely before, I just want to be clear. So you check into warrantability before you make the offer, right after, or early in the process?
Early in the process. If we can get those answers before, it's very difficult. Sometimes the HOA is not helpful. Okay, they're unwilling to give the information without costing you money. So, but again, we have an extensive database, and typically the realtors know if there's litigation or issues. So we want to talk to them. You want to ask them about any issues. And FHA maintains a database. VA maintains a database. If you're going with those type of financing, we'd be glad to look those up for you as well. But yes, sooner the better. Because we don't want you to be surprised later in the process with having to change terms because the condo is non-mortgageable.
Great. Yeah. This, your point about the big banks and, the difference between working with a big bank or a big national online lender and working with a shop like Bond Street is this kind of stuff, right?
Yeah. And you can say, well, it's Chase, JP Morgan Chase, they'll finance anything. It doesn't matter. It's untrue. They follow the same condo guidelines that we do. They just will not even go as far as portfolioing the deal. And so they will deny the loan, where we have alternative options for the consumer, for you to finance it if you so choose. So it's better to have that conversation up front. And the big banks are very, it's very segmented on how your file flows through them. So by the time it gets to the condo department, like I said, you could be 45 days in thinking you're closing next week. And then finally, the condo department picks up the paper and says, "Oh, this is a problem." So we get a lot of fall through, especially here in the New York City area, where there are a lot of condos, and it built a good reputation in getting a lot of condos done that other people cannot. And we take a lot of pride in doing that homework up front.
Great. Okay, well, I'm going to move on to rates, but I want to make sure this recording gets out to all the realtors we know. Anybody watching who knows somebody buying a condo, it might not hurt for them to watch the last 10 minutes of this right now. All right, so rates, where are they at? Still low, right?
Yeah, rates are at year lows here. So it's kind of interesting. Again, it's same old story when it comes to interest rates. Absolute gridlock in Washington. The sense of euphoria that the Republican Party won the White House and Congress, that we were going to get this pro-business administration to pass healthcare reform, tax reform, every kind of reforms. Well, the swamp is definitely winning the fight here. And of course we suffer as the American people. But the reality is, this morning you had bad durable good or lower than expected durable goods orders. The economic news has been, again, same a little bit of good, a little bit of bad, just a lot more of the same of what we've had for the previous 8 years. And I'm not saying that's a bad thing, but the reality is there's no catalyst for growth. There is no inflation to be seen. Wages are not increasing at the pace that the Federal Reserve expects. Factory orders, consumer price index, producer price index are low. So interest rates, the 10-year Treasury bonds specifically, that dictates the 30-year mortgage rate in this country, had gone up towards 2.5%, a little bit higher, I believe, actually at one point. And now we're back under 2.2%. We were 1.74 the day before the election. So we're kind of at the mid-range between the high and the low. It's I guess appropriate timing-wise. The 310 to Yuma is here. The showdown is upon us. And I think that the pressure is for interest rates to go lower at this point. Because
oh, wow. Okay.
I think we go. I think the 10-year bond goes to 2%. I think it may even go lower than that because it went from 1.75 to 2.5 within a very short time frame. So there's no support. Right now we're at the support level. I think today we're at 2.17. The low of the year, okay, was 2.13. That 210 to 220 range, there's a lot of consolidation happening there. If we break below that 212 level, we're going to go to 2 in a heartbeat. And I do see that happening. We are in the busiest time, or we're in the cycle as far as the year goes of the highest economic growth, right? Second and third quarter, typically you see the highest economic growth numbers. And it was very good second quarter, 2.6. That's nothing to shake a stick at. That's one of the higher numbers we've had printed on a quarterly basis since the financial crisis. It's unsustainable though. If you look at the forecast, and again, if you look at things like durable good orders today, they were, and they've been marking down their estimates, their forecast. They had forecast -6%, they were down -6.8%. So things have slowed down, and we're in that 2% range again. It's just that 1.5 to 2% growth. And that's where we've been for over the last 8 years. And until Washington can start working for the American people and actually, making reforms that work, especially for the working class, the consumer and the American people, I give them a lot of credit. We've gotten very smart over the last 8-9 years. We don't overextend ourselves. I mean, I did see something that, credit card debt was at a high, but also, there was more savings that came along with that. So, and we're growing as a population. So you're going to have, obviously, organically some higher numbers. So the savings rate is up. I saw new home sales were also lower than expected. So there is some tapering off. With our business, it does kind of get a little quiet now until the kids go back to school and then it picks up for the end of the year. But if interest rates didn't go up now through the spring market, okay, because that is typically the cycle, the banks know it and the markets know it, so they tend to trend a little bit higher because that's when the most volume of business is done. So if the banks can pick up a couple basis points on an interest rate, they're going to do that. When you're talking, 14 or $12 trillion in mortgages, that's the cycle that we're in. So I think, and again, the correlation that oil has gone up the last few days. We're still under $50 because of the hurricane hitting in Texas, and that's where I think 75% of the refining goes on. But oil, and you guys have all seen it too, right? Traveling this summer, the price of the pump has gone down instead of going up. And,
yeah, it's crazy.
It's never cyclically that I can remember that. That's really an anomaly. So that also reduces inflation because commodity prices are low. And even with the dollar weakening against the euro, almost 120, we were at 105 not too long ago. Now we're almost 120. And the dollar, oil is pegged to the dollar. So usually when the dollar loses value, oil prices go up as well. So it tells me, at least, in my opinion, is that the underlying inflationary pressures still remain subdued, and the Fed is hell-bent on raising interest rates, which is also going to cap growth and is also going to cap inflation. And I think we just continue to see more of the same, and I think we get a reprieve as consumers with interest rates going a little bit lower here, going into the third and fourth quarter especially.
So we're still around 4% on a 30?
You're lower. You're lower than 4% on a 30 today. Yeah, if you have excellent credit, 30-year fixed, you're definitely closer to 3.75 today.
Okay, maybe 3.75 with excellent credit. Cool. Okay. All right, James. That was really good. I really want to get this condo stuff out, and the thought occurred to me that we should show more of these episodes to people on Wall Street who understand half the stuff you're talking about. But I always learn a lot myself, and I hope everybody listening gets a lot of takeaways from this, because you really seem to have an understanding of how these markets work. And again, I think people would rather work with somebody like you than the entry level guy sitting at Quicken, so to speak.
I think often that obviously technology is a big part of that, and it's great as a society. We're smarter today, because information is available, and often people take for granted. They feel that a mortgage is a commodity, like you're buying a TV at Best Buy, and I always say that may be true for a percentage of people out there, that it is that easy because of technology today. But the reality is it's still a huge financial investment. And most of us don't make financial decisions with at least talking to somebody first. So, we're here to have that discussion. We're here to, and I'm confident, when it comes down to the rates and the fees, that as a company, we would be very competitive with any other offers. But it's, I think it's invaluable to have an advisor there with you to answer any questions. And, for myself personally, and a lot of the advisors on our team, we have many, many years of experience. And I always say, next month will be 21 years in this business. So in those last 21 years, I feel like I saw about 50 years of financial history happen before my eyes. So we've seen a lot, and I'm glad to put that to work for all of our clients.
Great. And I'll just close out here. Just a little thing for agents, to remind agents who are watching, bondstreetmortgage.com/agents. There's a case study I did there, 686 clicks for $64. That's about 8 cents. I think it was 11 cents a click. And I think the takeaway there is not enough agents are using Facebook to drive direct traffic at their listings. And it's a really, if you want to make your sellers happy, and you want to get more direct buyer leads, higher quality buyer leads on direct property inquiries, check this case study out. And that's about it. Check out bondstreetmortgage.com/agents. We'll get this recording live here soon, James, for anybody who wants to see it again. And anything else you got?
I'm great. Have a great weekend. And if we don't catch up next week because of the holiday, we'll do our best. But I'll say happy Labor Day, and thank you, everyone.
Okay. See you later.
All right. Bye.